Since the beginning of January, the Dow Jones has lost 5% of its value, which is a horrifying start to 2022 for a lot of investors. People are selling off before they lose too much value. Meanwhile, half of my YouTube feed is full of people saying, buy the dip, buy the dip, buy the dip. And the other half looks like this. Oh, the online drama. The question is, in a time where it feels like you have to make a money move today, what is the best move to make? Or should you do anything with your money? The answer may surprise you, so let's get into it. In July of 2021, Charles Schwab published an article where they outlined the findings from a study where they looked at historical returns in the stock market. They broke down 5 hypothetical characters and their investing strategies with their annual $2,000 bonus from 2001 to 2020. And I should mention that their returns followed exactly with the S&P 500 during that time. You're gonna fit into one of these categories, if not a combination of a couple. The first person is Peter, and he timed the market perfectly by putting his bonus into the stock market at the lowest point every year. The second investor is Ashley, and she put her whole bonus into the stock market every year immediately after she received it. Matt was the third investor, and he took an average amount of his bonus and put it into the stock market at the same time every month during each year. The fourth investor, Rosie, unfortunately timed the market very poorly and put her whole bonus into the stock market every year at the highest point. And the fifth character was Larry, who never put his bonuses in the stock market and instead just kept them in cash investments. Then Schwab analyzed the last 76 20-year investing periods all the way back to 1926. And here were the findings, which were remarkably consistent. Overall, in 66 of the 76 periods in which they looked, Peter understandably ended with the most amount of money while timing the market perfectly. Ashley ended second while lump sum investing her bonuses, followed by Matt, who dollar cost averaged his bonus every year. Then Rosie came in fourth with her poor market timing. Then Larry came in last while not investing in the stock market at all. I don't trust the markets. But the most interesting thing is this. Peter earned a total of just over $151,000 in the 2001 to 2020 period of time. Ashley was only $16,000 behind with just over $135,000. Matt was only $615 behind Ashley. Rosie came in at $13,685 behind Matt, and Larry was a solid $76,000 behind Rosie and over $100,000 behind the first place Peter. I still don't trust them. So what do we gain from this? Well, the clear answer is lump sum invest your money. Killed by maybe a simple fisherman, but I do know that $151,000 is better than $135,000. Whoa, let me explain there, Captain Ahab. Literary joke. Timing the market perfectly obviously creates the best result, but it involves an immense amount of speculation and luck. Look at this graph of the Dow Jones Industrial Average from 2018. If you invested your bonus at the first major drop of the year, you'd miss out on the greatest drop in December. The chance of you timing the market perfectly is incredibly slim, and if you try, much of the time you'll invest based on emotion, which causes you to buy high and sell low because that's our natural reaction. It's hard to pass up a stock when it's growing and performing well, but when you do buy it, you may be buying it at the top of the curve. So instead of trying to wait for the perfect time to invest, just take all the emotion out of it. Lump sum invest your money. It performs second best of all the investing strategies 93% of the time period studied. And if throwing your money into the stock market right now makes you worried that you'll miss out on an even lower point in the market to buy later, then just dollar cost average it like Matt. It performed third best in 93% of the time period studied, and it came in barely behind lump sum investing in the time period between 2001 and 2020. Now what I'm saying in this video is not don't buy the dip. If you have the money, go for it, because it is a good time to buy. But I have 5 quick points that I want you to check in your specific situation before buying said dip. 1, don't buy the dip because you're experiencing FOMO. Don't make your money decisions based on emotions or what your friends are doing. 2, don't buy the dip with money that you don't have. Leveraging money for gambling in the stock market is never a wise decision. And what we teach through financial coaching is to avoid investing anyways until you have all consumer debt paid off. It's the only way of not effectively investing with money that you borrowed. Number 3, don't buy the dip with the plan of making a quick buck. I don't deny that right now there's a chance that buying some stocks could get you a quick ROI on your money. But investing is a long-term game, and you're less likely to make mistakes if you're buying for the purpose of keeping those investments for 30 to 40 years. Number 4, if you do buy the dip, consider something a little bit more diversified than just single stocks. Single stocks can be dangerous financially speaking because if they drop in value, there's nothing to catch them. If one stock goes down, there's a better chance that the rest of the stocks will keep the whole fund from going down very far, just based on averaging. It doesn't mean that a fund won't go down, but it can soften the blow. And it's much more likely you'll get consistent growth from a bunch of stocks across many companies and industries. And 5, if you're gonna buy the dip, don't wait to see if the market goes down even further. Investing your money in lump sums will historically get you the most money in the long term. When you separate it from the luck of timing the market perfectly. I will never throw out a blanket suggestion to buy the dip because I have no idea what kind of financial situation you're in. Everyone's different, and I don't want to be responsible for you throwing money that you don't have into the market just to make a quick buck. Overall, I just wanted you to see that if you're wanting to grow your wealth, holding investment money in cash just so you can buy the dip when the time comes is only a good strategy if you're cool with relying on luck, or if you're inside trading. That's illegal though. Even though this might be a good time to buy, just recognize this. You don't have to wait for a time like this to get into the market. I don't personally buy the dip because my wife and I just invest consistently in our retirement accounts. For one, it gets us in the market in somewhat of a dollar cost average type of strategy because we don't have extra money to just throw in lump sums into the market. Two, it takes all emotion out of our investing. I'm not looking at the market all stressed out right now because our money gets invested in it regardless of how well it's doing. So in this case, we're technically buying the dip, but only because this is when we get paid and our money gets automatically transferred to our retirement accounts. But we aren't putting anything extra into the market aside from the 15% of our paychecks this Friday. Now, I'm not a financial advisor, so I'll never recommend that you purchase a certain stock or something like that. But what I can do as a financial coach is help you get to a point in your financial life where you're able to wisely and comfortably invest. If you're interested, hit the link in the description down below so that we can set up a time to talk. It's a totally free consultation and we'll make a decision together if financial coaching is right for you. Because I'll be the first to tell you from experience, it's not for everyone. Meanwhile, if you want to learn the best way to start investing, then watch this video next. And if you want to figure out the amount of money that you specifically need to save for retirement, then check out this video right here. Thanks for sticking around.